Now, Meta and Amazon both got upgraded. Why did they get upgraded here today? Okay, Meta stock gained on Thursday after Wall Street analyst team raised their price target for the social media stock. Amazon also got a price target hike and closed the day higher. A new report from Jefferies on Thursday reiterated a buy rating on Meta. Analyst Brett Thill upped Jefferies' price target for the company to $585 from $550. Separately, he raised Amazon's price target to $225 from $190. So if you're wondering why Meta and Amazon held together well compared to the market and a lot of stocks today, this is why, okay? Meta has too many advantages to count. Could get added boost from AI, Jeffrey says. Meta Platforms is a digital advertising juggernaut, but the company's targeting abilities and technical prowess could lead to 2024 being the best year ever, due in part to the generative artificial intelligence, Jeffrey said. Quote, based on our updated market share analysis, we believe Meta could capture 50% of incremental, extra, new, industry ad dollars in 2024, which would be the highest ever and well above its 33% in 2023. Ad revenue could grow at 20% or more than twice the industry average of 9%, aided by generative AI. Holy smokers, this is no dang joke. It's Meta's moat. Meta was negatively impacted after Apple made several privacy changes in 2022 to iOS 14. Since then, the company has managed to regain market share and sees accelerating revenue growth due in part to $27 billion in capital spending in 2023, which may have helped the company develop several strategic advantages over peers. Quote, firstly, the AI recommendation engine has continued to improve with Reels driving 25% growth in time spent watching videos, 100%. As somebody that uses Instagram, yeah, they've gotten pretty freaking good at that, I'll say that. Secondly, the Advantage Plus suite of ad tools have driven significant improvements in advertisers' ROI, return on investment, well beyond competitors. Finally, Meta is seeing impressive momentum with click-to-message ads, which have already eclipsed a $10 billion run rate as of Q4 2022. Additionally, Meta is likely to keep benefiting from additional generative AI tools, such as an image expansion, text variation, and background generation, all of which will likely result in meaningful improvements in click-through rates. What do I say on this? Preach, preach, preach. He is preaching to the choir, okay? As a Meta shareholder, these are all things that I 100% agree with, and I'm glad more and more folks are coming to this realization, right? And so, Meta's numbers this year, really regardless of what happens in kind of the macroeconomic landscape, should be phenomenal, absolutely phenomenal. The company's clicking on all cylinders, and it's beautiful, okay? Absolutely beautiful. Now, another situation happened here. Alphabet, Meta, and Amazon in focus, and we'll get into the other Amazon upgrade in just a moment, in focus as Webbush sees significantly increased ad spend. Alphabet, Google McDougal, Meta, and Amazon were in focus on Thursday as Webbush Security said in a recent survey showed U.S. ad spending has increased significantly in 2024 compared to the end of 2023. In the first quarter of 2024, 48% of marketers grew their digital advertising spend by at least 10% year over year, with 12% reported growth of over 20% year over year, says this analyst. Advertiser sentiment is improving, with expectations for stronger growth in 2024 relative to our prior survey work. So, moral of the story is, it sounds like especially Meta's number is going to be phenomenal. But Google's obviously an advertising giant, so they should benefit from that as well. Not as much as Meta, likely. And Amazon's an advertising giant now as well, so they should see a benefit from that, okay? But hold your horses for just a moment, right? Because there's two ways to look at this. One is your business is really strong, so you have extra cash flows to advertise, right? So let's imagine I have a car detailing business, right? So I have this car detailing business is super strong, and I'm seeing great results on my Instagram ads, so I want to spend more and more and more, right? Okay, that's one way of looking at it. The other way of looking at this, if you want to take us, let's call it a glass half empty view, right? Because we can always look at things glass half full, glass half empty. Let's imagine my car detailing business, I'm not quite getting as many calls as I was getting before, right? Maybe the consumer's getting pinched up yet. So now instead of getting their car detailed once a month, they're getting it detailed every 3 months or 6 months or something like that, right? So I'm like, crap, I need to generate more business. So I'm like, I need to run more and more ads on Instagram, more ads on Facebook, because I need to get customers. So, business is tough. So I need to run more and more ads. So you could look at this glass half full. Everything's great. Let's spend. You could look at a glass half empty. Oh, the times are getting more challenging. So therefore I have to up my ad spend to get money through the door, right? So I don't know which it is. It's really hard to tell because we're getting all this conflicting data at the end of the day from all these companies. And so I don't know. We'll see. Okay. We'll see. But at the end of the day, companies like Meta, they put up their numbers regardless of what's going on, right? Amazon, still plenty to like. Separately, Thrill and the Jefferies Internet Analyst team published a positive note on Amazon Thursday after meeting with industry experts and former employees. Amazon has positive opportunity in advertising supported video in its Prime streaming platform and improving cloud environment from its Amazon Web Services business, according to the note. The Jefferies analyst team added, however, expert believes Amazon needs to improve its AI offering to stay competitive. Okay. Amazon has not yet set a date for first quarter earnings. FactSet estimates report coming later this month. Amazon shares have gained 20% so far. So in regards to Amazon, I really view them as a must-own stock, okay? And I'll share in just a moment the 5 must-own stocks that I feel like should be in everybody's portfolio out there. But I could look at this Amazon Web Services situation. Did you see what happened yesterday? It was either today or yesterday. Sometimes the days run together, right? It came out that Amazon Web Services is actually cutting a bunch of jobs, okay? Now, there's 2 ways of looking at this. You want to go glass half full, you want to go glass half empty. We can go both, okay? Glass half full is Amazon has some employees that maybe weren't cutting the mustard in AWS. They need to get rid of those employees, right? Maybe they're toxic to the culture, whatever. Maybe it was to send a threat to the other employees of like, get your stuff together, salespeople, like make sure you're doing a great job or you're going to be out. That's a way of looking at, I guess, glass half full. The way of looking at it glass half empty is maybe AWS numbers aren't looking as strong as Amazon thought, and therefore they're cutting those employees. So once again, we don't know. We're not insiders in the company. We'll find out in their numbers. If I had to go, I would go glass half full in regards to that. Now, what are the 5 must-own stocks, in my personal opinion, that it's just, you got to own these stocks, okay? Like, to not own these stocks is almost sacrilegious in terms of stock market terms to not own these 5 stocks. You got to own these ones, okay? Everybody's got to own Meta. Everybody's got to own Amazon. You're talking about the dominant advertising company in the world, just impossible to compete with. You got to own Amazon, the e-commerce giant, the service that the internet runs on, AWS, right? You gotta own Amazon. You gotta own Shopify with their e-commerce opportunity and just in business in general, and they continue to expand that business, right? From what I heard, they're stealing away employees from Salesforce now, as they push further and further into B2B e-commerce and the back end of businesses. Shopify looks like they want to become more than just a small business type company. NVIDIA is one of those must-own companies. It's just, you got to have some sort of position in NVIDIA. You can't not, right? And the 5th one would be either Alpha or Celsius. There's 2 of the most well-run companies of the past 5 years in the stock market. And those 2 just, you got to own them. You got to own them. You can't just, you got to own at least one of those, okay? And so my opinion is those are must-own stocks. You just got to own them, okay? Now let's go ahead and get into Meta.
Long picks. Mark Mahaney, Evercore ISI, head of internet research, joins us now. So, Mark, you have a buy on Meta, price target of 550. So, which raises the question, there's not a ton of headroom between where it is now, 523 and 550. You're up around 25 times earnings. They've announced their first dividend. I guess the question is there anything left for the market to be pleasantly surprised by here?
The truth, Mike, is there probably isn't a lot. This is a small buy for us. Fully respect the move that we've seen year to date and over the last 18 months. This is one of the biggest pivots I think I've seen in my 25-year career. A stock that corrects 90% and then comes back to all-time highs. By the way, I think Netflix and Spotify are going to do the same thing, but it's just rare you see that. But there are some, I think this is a compounder here. I think it can hold this multiple, Mike. I think, 22, 23, 24 times earnings, something like that for an asset that I think can sustain 20% plus earnings growth. That's legit. And then there are these kind of longer term new growth drivers like WhatsApp monetization.
So I don't think it's just about holding the current valuation. Meta deserves to trade at a bigger valuation. Meta deserves to be trading in a forward P in the 30s easily. If they're putting up 20% revenue growth this year, you've got to slap a 30 or a 40 forward P on it. To have it at a 20 is that's just not understanding how stocks are valued. That's the best way I can put that. It doesn't make any logical sense. So if a company's growing revenues at 20+% and it's a safe, great business model, you have to put a forward P of the 30s or the 40s on it. That's just bottom line with that, right?
Facebook Marketplace, and then maybe virtual, reality, augmented reality with their Reality Labs business, maybe. So there's some things to stick around with, but it's a smaller buy for us here, no question about it.
Yeah, and if you do think that Netflix and Spotify can do that round trip after those nasty sell-offs, it must mean that you think, there's at least 10+% upside in each one of them because, Netflix is, I guess it peaked around 700 or thereabouts. What's going to get it there?
Not that far away.
Well, you remember what last peaked Netflix? It was that the South Korean drama thriller.
Oh, yeah, Squid Game. Yeah, sure.
Thank you. I've forgotten what that was. Anyway, it's coming again. We're going to see it again this year. So, that's just one thing. But this really just strong sub growth. Look, step back on Netflix. This is what's happening. You're getting back to 20 million a year sub ads. An industry that was seeing rising in competitive intensity for like 3 or 4 years up until 2021, that's waning now. Free cash flow is inflecting up for Netflix. And then there are some interesting new growth drivers out there. There are big growth drivers out there for Netflix. There's this paid sharing initiative, which has worked out really well. And this ad-supported business, they took the best streaming business in the world and they cut it by 30%. Of course, that increases the TAM. So
Is Netflix still a buy? I would say it's still a decent buy, but it's certainly not the buy it was, a couple of years ago when that stock was trading $100-something, $200-something, just a couple of years ago, back in 2022. The summer of 2022, I actually bought Netflix stock for the first time ever. I never bought Netflix stock before, and I actually bought it. Made some good money on it. Sold. I probably should have just ended up holding the shares in the end because it's gone up several $100s more since that time. But, Netflix, another one of those companies that pretty much is always a buy. But it's not nearly, that upside's not there that was there a year or two ago, right?
Good reasons to stick with Netflix, but it's a small buy. It's very hard to find dislocated buys in tech today. We should all acknowledge that and just be
more. If I recall, I picked up some shares for like 185 back in like 22, which is just insane.
In our long positions in tech.
Mark, earlier this week, I was at the Sohn conference where I sat down with Josh Resnick of Jericho Capital. It's a long-short equity fund that participates in the TMT space, tech, media, telecom. He really likes Meta. And the reason is he thinks that their kind of AI-targeted advertising monetization potential is just superior to their peers. And I'm curious, based on your channel checks, do you agree with that? Just the ability for AI to pinpoint certain ads at certain times of day, knowing the colors potentially that a user might like and be more likely to click on a certain ad. Is Meta kind of the best in class when it comes to using AI for advertising, or do you think there are others out there that are doing similar things that people should be paying attention to?
I've got nothing but respect for Josh Resnick. He's one of the smartest investors I've ever worked with. I think he's dead right when it comes to Meta. People are looking for all the Gen AI plays. What chip plays can I find? What infrastructure plays can I find? I've got the killer, and he does too. He's got the killer app winner off of Gen AI, and it's Meta. They used AI to completely revamp. They were forced to, but completely revamp their ad tech stack. And they've also used it, by the way, to improve their user stack. I mean, this has gone from a social media company to a media company, the way they bring in the content. You've seen it. You've seen a rising engagement on the site. So they've really done a wonderful job here. It was very hard to see that, really to look at that about 2 years ago. But if you you would have realized on a big correction, you want to make this your biggest long. So I think that call is absolutely right. If you're looking for the app play for AI, it's right here. It's Meta.
So is Meta still a buy, right? It's obviously gone up tremendously. And do I view it as a dangerous stock, a safer stock than I view, like, let's say, other big techs? And the simple answer is Meta stock a buy? The answer is yes. Is it it far safer than pretty much all other big techs? Yes, as well. And the reason being is you're getting Facebook, you're getting Facebook Messenger, you're getting Instagram, you're getting Threads, you're getting WhatsApp, and you're getting Oculus and the VR opportunity long term, right? And so it's just hard to find a company that has that many major big businesses out there trading at a forward P in the 20s with 20% plus revenue growth expected, with probably even, well, I would say not probably, almost for sure, better bottom line growth, with a balance sheet that it has there, right, with still a founder-led company, which is hard to find in big tech nowadays. And so when you put all those components together, it's still a buy. It's going to 1,000. It's going to 1,000, and then we'll see where things shake out from there. What could negatively affect Meta stock price? What could damage it? At this point in time, it would take a black swan event. Some sort of epic recession. Obviously, everybody in the advertising space always gets hit in that sort of situation, right? What other black swan event could happen? I mean, if iOS and Android both change their terms of service in some substantial way that somehow really dented Meta's business model, but it seems like they already did that game, a few years ago. So at this point in time, I think it's hard to even see a black swan event taking down Meta, right? They've already dealt with the government on so many different angles over the years, and the government's going to be very tied up with Apple and Google and Amazon over this next few years that they can't take on Meta as well. That's just, and they already dealt with Meta. They already did so much with Meta over like a 5-year span. So now it's Apple's, Google's, and Amazon's really time to go through that whole process, right? And I think Amazon's the least I'm worried about in regards to that. So the moral of the story is Meta's still a buy. Is it the buy it was at 2022? No. Is it still a moneymaker stock? Yes. Is it a safe play? Yes. It's just, if it was a one-trick pony, if it was only Facebook and you didn't get Instagram, Threads, WhatsApp, and all those other things, I wouldn't be interested in this stock. It'd be too dangerous. It'd be like, man, if anything happens that way. But when you're that diversified and you got 3 billion plus users, it's all gravy. And especially, they got growth levers all over that company. It's ridiculous. All right, next one up here. Apple lays off 600 employees. First significant round of job cuts in years. This is interesting.
Is buzzing about Apple layoffs, cutting more than 600 employees, according to a new state filing in California. The layoffs are the first for Apple since the pandemic and come shortly after the company shuttered its self-driving car project. Unlike many of its big tech peers, Apple was more conservative with its hiring during COVID. The reduction in headcount also comes with Apple lagging behind its other peers in the Magnificent Seven. But we've seen this, Carl, where companies who were aggressive in hiring and boosting their headcount during the pandemic then has to kind of do this revision to the mean and cut some more jobs. Apple is kind of the contra to that example, although now you see 600 layoffs.
Yeah, although it's hard to argue that it's bitten very much at the macro level. Goldman has a piece out a couple of moments ago just arguing.
Apple is so lucky. Let me explain to you how Apple is so lucky. Apple's going through a bad time, very tough times for their business model. Their numbers are very weak. Their numbers could get even weaker here in the short term. Things are not good at Apple right now. And there's so many questions about innovation and where this company is getting growth from in the future. And on top of that, they got the government coming after them. But they're so lucky this is all going on in a good market. Because I'm telling you, if this wasn't all going on in a good market where the S&P's at all-time highs and the NASDAQ's at all-time highs and all these other big tech stocks are running, Apple would be an $80 stock today, a $90 stock today. It'd be devastating. But since it is a great market right now and it's great for big tech, Apple's holding decent. Now, keep in mind, it's still, underperforming the market 20 percentage points or whatever this year. They're lucky. They're very lucky. I'm telling you, if Apple is going through what they're going through right now in 2022, it'd be a $70 stock. $70 stock. So they're very lucky.
Why they think we can have above consensus GDP growth this year and inflation coming down and getting 3 Fed cuts. They say, we're often asked, are those two theses contradictory? And they just don't think so.
No, and that kind of echoes what we heard from Hotsius earlier today, with the Lake Como as the backdrop.
Yeah.
But it's just remarkable what we saw with payrolls this morning and just the overall state of the economy right now.
Yeah, and do I think there's more Apple job cuts coming? I don't think there's substantial more Apple job cuts coming. And the reason being is, one, Apple didn't overhire like a lot of the other big tech companies did during that kind of 2020, 2021 time frame, like Meta did and many other companies, okay? So I just don't think there's as much fat to cut at Apple as there was some of these other companies, right? And then additionally, I do believe Apple can actually get back to growth next year. They're supposed to come out with bigger iPhones, and I think they're going to sell well. Anytime Apple comes out with a bigger iPhone, it sells freaking well. And so I do believe Apple will get back to growth next year. And so that leads me to think there's probably not more big job cuts coming for Apple. If anything, it would be another like small cut, but nothing like huge there, okay?